And joining me now with more is Stacy, economic strategist and wealth manager at Scarlet Oak Financial. Francis, great to have you on the show this morning. Joining us from Tampa, Florida, and with stocks near record highs, does this market look attractive to you?
It really does. And it's interesting just coming off of all-time highs, which of course you're never supposed to buy coming off of all-time highs. But what's interesting is that the implied volatility is running at about double the rate of the realized volatility for the S&P 500. And I think that a lot of institutional investors were positioned short and had their hedges in place for this August 1st trade deadline. However, with the positive momentum from the EU deal, we've got China talks tomorrow, Fed on Wednesday, July payrolls on Friday, as you mentioned, the tech earnings. There's a lot of room for good news there, barring any surprises. I think that the market will continue to drift higher.
Interesting. What does this mean for interest rates?
Well, it's interesting. Rates are probably going to remain higher for longer, and that's because commodity prices have been on the rise, which indicates that there's more inflation risk to be priced in moving forward. There is a lag effect between those commodity prices and hitting the headline inflation number. So the Fed is lucky because the decision is on Wednesday and the payroll report is on Friday. So it just gives him, all the more reason to stay pat, unless he feels, in his discussions with Trump, that he should lower rates. I see no change on Wednesday with the Fed.
Mm-hmm. The path forward for rates, though, I think very much in focus amid questions about trade policy and how it could potentially impact both the jobs market and inflation. Of course, the Fed has a dual mandate to focus on both. Francis, as an economic strategist here, what do you see as the potential impact on inflation and jobs?
Well, the funny thing about the dual mandate is sometimes those interests are aligned and sometimes those interests are opposed. It just depends on what economic season you're in. If you're the White House, you want him to lower rates because you're having to roll over a lot of short-term debt that was purchased during the waning hours of the Biden administration. And, those higher interest rates are going to be costing, I think Trump threw out a number, $900 billion to taxpayers. And so that's obviously one of the reasons he wants to lower rates. You've got 60+% of the U.S. economy, living paycheck to paycheck and relying on credit cards with those onerous interest rates that are insane. Yeah. And so this can all sort of unravel into some kind of a credit situation. Barring that, the economy is hanging in there because the fiscal spending has sort of replaced what's come off of the balance sheet with monetary policy being tightened. And even though they lowered rates a couple of times, they're still reducing the balance sheet. So it'll be interesting to see what Jay Powell says about that on Wednesday. So they're still in a tightening stance, but fiscal still in an expansion stance. And so far, fiscal has won the day.
I do want to ask about gold because just as the market has risen to record highs, we've seen what's been an incredible rally in gold prices. Francis, how do you look at gold as it relates to equities, and what is your expectation for that commodity moving forward?
Well, the thing is gold made multiple all-time highs based on central bank demand, physical gold demand around different various risks around the U.S. dollar, potentially being replaced as a world reserve currency and other risks. However, gold historically trades inverse to real rates. So if real rates continue to rise, probably lowering that gold position, it's had a number of lower highs. So unless you put some huge global macro risk back onto the table and there's a catalyst that changes, gold will probably pull back. I don't see a major sell-off. You could buy on the dips, but I think that if Trump continues to get these trade deals done, you're going to see waning volatility. That risk is going to go down, and gold will probably sell off in favor of risk assets.
Yeah. So as these trade deals have been coming in with that August 1st deadline this week on Friday, we've seen volatility relatively low. Equities have been able to rise seemingly in that sort of environment. Are these trade wins? Is that how you would categorize them?
Well, certainly the EU benefits the United States. Even the EU is calling it very lopsided because not only did you get the 15% tariffs, you got no tariffs on AI. NVIDIA was a big winner on that point. And then you've got the over $1 trillion of investments coming in on both energy and infrastructure in America. So that was a big win for America. I don't know if the Chinese deal is going to be as favorable, but if it is, the markets will price it in. The worst case scenario on trade was Liberation Day. And of course, before this EU deal was made, Trump had threatened, tariffs as high as 50%. So the fact that now they're back down to 15 is actually good news for the market. The market has had waning volatility in the absence of, waning realized volatility. There's quite a premium in implied volatility, realized volatility, because, with kind of pushing these deadlines off, it's just very hard for analysts to stick a particular number on any one of these deals in the calculator. And that's smart on behalf of the administration. So you just don't have a bunch of changing calculations happening on one day, which would heighten volatility. So again, barring some kind of catalyst in credit markets, with the job situation, something the Fed says, I do see that we drift higher as we wait for these deals to roll in.
All right, Frances Stacy, economic strategist and wealth manager at Scarlet Oak Financial. Frances, thank you so much.
Thank you, Kristen.